Welcome to Beyond Wall Street, presented by Arixa Capital, where expert investors make their unique investment strategies easy to understand. I'm your host, Jan Brzeski, and today I'm talking with Don Plotsky, co-founder and managing partner of Uinta Investment Partners. We'll be discussing litigation finance as an investment strategy, among other topics. Don, when you and I met, I think you were ending up your long career in the fixed income area, in the bond area primarily, and you are a strategist for one of the largest bond companies in California, bond managers. And since that time, we've talked a lot about other income strategies. So I think it'd be great if you could start out by maybe telling us a little bit about your career path and also both Uinta Income Fund and the AIS Foundation Fund, which you also manage.
Thanks, Jan. Yes, I had an extended career, 35 years in the fixed income business, and having entered fixed income back in the mid-'80s, yields were quite attractive, and fixed income offered the three things that fixed income is supposed to offer, which is income, safety, and liquidity. And one of the things that happened throughout my career is that while they continued to offer safety and liquidity, the income component really vanished. So we went from double-digit yields on 10-year treasuries to near zero. And the idea of safety changed as well. So while bonds are not nearly as volatile as other investments such as equities, the low yield really ate away at the margin of safety. And therefore, I decided to leave the fixed income arena and pursue other income-oriented opportunities that could provide investors with the things they traditionally had looked for from bonds.
So why don't we jump into what led you to the path that you're on? I think a lot of investors might say equity markets are doing well. In alternatives, there's private equity, there's venture capital, there's real estate. So what got you interested in investing for income?
Yeah, really, it's the idea of diversification. And that is that everyone I know with some degree of wealth has exposure to equities, has exposure to real estate. As people's wealth increases, they have exposure to private equity in one form or another. And when I decided to start Uinta with my partners, the basic idea was, what don't people have? What is it that people need that they really don't have in their portfolio? And the baby boom generation, at least the higher income earners within that cohort, really have accumulated a pretty good amount of capital. The stock market has done extremely well. The real estate market has done extremely well in our adult lifetimes. And therefore, you're dealing with a group of people who've got a significant amount of capital. And the question is, how do I take that capital and create income? And back in the day, it used to be bonds. That was the answer. It would have been easy enough when government bonds were yielding 6, 7, 8% to build a laddered portfolio of government securities and live off the income from that. But that's no longer doable with yields at 1.5%, 2%. So the idea was to pursue income-based opportunities that investors generally either hadn't heard of or didn't have access to. My background really is in structured finance, having grown up on the mortgage side of the business and then the asset-backed side of the business and doing asset liability matched portfolios, and really having done structured finance most of my career. The idea was to create a let's call it a completion portfolio type concept, where you could take either your fund and my litigation fund or my diversified fund, plug it into your portfolio and create that income component that otherwise would be missing.
Okay, great. So let's get into litigation finance. So what did you find so compelling about it? First of all, what is it? How does it work? You know, I see a lot of billboards for people that, you know, that might have gotten in an accident with lawyers, phone numbers. Is that related to litigation finance?
Yes, it is. So really, litigation finance breaks down into many subsectors. But consumer litigation finance has to do with individuals who have either work-related claims or accident-related claims, or in some cases, mass tort-related claims. And it tends to be a very large number of small claims that we focus on. So we work with the funding companies. So the way the allocation of effort breaks down is you've got the plaintiff who's been hurt. They go to a lawyer. They talk to a lawyer about the case. Lawyer says, I will take it on a contingency basis. The individual, if they don't have the means to support themselves or pay their medical bills during their time of incapacitation, very often they'll say to the lawyer, hey, I need money now. And the lawyer will refer them to a funding company. The funding company will evaluate the case. I like to call it checking the box, make sure that there's a real injury, there's a police report, there's a medical report, there's a responsible party. Once all those things are ticked off, then they will advance roughly 10 to 20% of the value of the case. Now, since these are fairly common cases, auto accidents, workman's comp, there's an enormous amount of data out there about what the awards tend to be for those types of injuries. So they have a pretty good data set from which to work, and they'll advance, again, 10 to 20% of the value of that case. We come in and we offer liquidity to the funding company. So if the funding company has $10 million to put out on the street, they'll fund 10 million, and suddenly they've hired salespeople, they've built an office, they've got a whole operation to originate, but they've deployed all their capital. How do they make the next advance?
So someone comes in and they've been in an accident and they're going to get $1 million, let's say, based upon the data of what their injury was, and there's a responsible party. So the litigation finance company will advance $100,000 to $200,000 maximum, 10 to 20%. So how much of that $100,000 to $200,000 are you funding? Are you funding basically up to 100% of that, which it should still be a good loan to value, because the value of the underlying case is $1 million. Even if you put up 200, you're still well covered on average, as long as the underwriters are doing their job.
That is correct. That's correct. So the funding company will evaluate it. They'll underwrite it. We typically will re-underwrite it. We will hire outside people to come in and review the cases, review the documentation, really more review the processes that the funding company uses. Because in our model, we think of ourselves much like a Fannie or a Freddie, in that we're liquidity providers to the originators. So we want to make sure the originators we work with have a robust process for originating the cases, for underwriting the cases, and for settling the cases. And so we'll do a lot of work on the company itself. Once we identify a company we want to work with, then we'll buy on a serial basis, forward flow basis. We'll buy cases as they originate them, subject to our underwriting conditions. So each time we do a purchase, we'll send things out for underwriting.
What about skin in the game, right? I would expect that you'd want to see that the people that are originating this loan, they have some of their own money in the deal, and perhaps it'd be nice if it was even, in a first loss position, so that they would, if they were wrong about the value of the case, it would hit them before it would hit you. Do you require skin in the game sometimes? Not always. And again, I don't know how the industry is set up, so that may not be a norm in your industry.
Yeah, typically on large cases, we would rather partner with the funding company than buy them outright. So on large cases, that's definitely the case. On the smaller cases, we prefer to buy portfolios of cases. So if we buy 2, 3, 5 million at a time of cases that have been underwritten, what we want is the funding company to have a vested interest in the back end. So typically we'll structure it where the deal flows as follows. We get all cash flows flow to us once the deal is closed. We continue to get all the cash flows until we receive our purchase price plus a stipulated IRR, the preferred rate of return, till we get that return back. Once we hit that trigger where we've gotten our purchase price and the IRR, then we flip to a sharing formula. So the excess cash flows that occur from that point forward will split with the funding company on some basis. And it varies deal to deal what that split is. But that way, the funding company, who continues to service those advances once we purchase them, has a vested interest in the outcome.
What would be a typical loan amount per loan in the portfolio?
They're not exactly loans, they're advances. We're basically buying liens against the awards, and the average size is usually about $10,000.
I see. So you need a lot of these. So the awards are in the kind of the $100,000, $50,000 to $100,000 range typically, and you're advancing 10,000 or so on that. And what's the target return that you're aiming for? Not necessarily a net return to your investors, but on that individual lien. When you advance 10,000, you're looking to get back 10,000 plus how much? And how many, does it take 6 months? Does it take a year? How long does it take typically for these liens to mature and pay off?
Right. So typically we're looking for a mid-teen IRR on the investment. That mid-teen IRR equates to a net return to the investor of about 10 or 11%. And the difference really is cash drag, legal expenses, due diligence expenses, administrative expenses, and management expenses. Mm-hmm. So that 10 to 11 really starts with that gross return of 15% on capital invested. So on average, you get your cash back, or you get most of your cash back in 18 months. The kind of expected average life is more like 3 years. So we've structured the portfolio so that we lock up the capital for 3 years, we handle the reinvestment, and we target a 10, 11% net return to investors.
And then what's the total return? High teens?
So the total return, yeah, we would expect in the 15 to 20% range. And it's pretty much all over the map. In certain cases, we're only doing financings, in which case we only get the preferred return. In other cases, we're buying things outright, so our return could be as high as 30, 35%.
So this is really an investment that spans equity and debt. There's almost like a universe of investments available within litigation finance. Fascinating. Well, certainly, I think most people would be interested to know if there's a way that they can benefit from this industry that we all know is out there of people being injured, litigation, settlements. So I think it's a welcome new strategy for most people to think about. So moving on to sourcing the investments, how hard or easy is it for you to find new investments when you do have cash available?
Yeah, that's the biggest challenge in building this business, is that there's always plenty of product available, but it's not necessarily a product you want to buy. It's finding the right companies to work with. It's building the business relationships with those companies. It's coming to a mutual agreement about what the risk parameters are for the capital that we're willing to deploy.
One thing that occurs to me is that this is not correlated with the stock market. It's not really correlated with the bond market. It's moving to an entirely different rhythm and its own rhythm, which is one of the benefits. So maybe we could segue into, why do you think people find these types of investments compelling? And then as a follow-on, maybe you could talk about your multi-strategy income fund and what are the other income strategies that you have besides litigation finance in that fund?
Right. So litigation finance certainly is not correlated to the bond market or equity markets. Having the diversified fund gives us a separate pool to manage, really with the same objectives. And the objectives are very low risk of loss, high income, and little or no correlation to the broad market. So same set of objectives, different pieces generating those returns.
Great. And briefly, what are the strategies in the specialty finance fund, the multi-strategy fund? Just you could tick off roughly in order of scale in the fund.
Yeah, so real estate finance, and for full disclosure, we do have an investment with Arixa as one of our real estate allocations. But specialty real estate finance, education finance, insurance finance, media finance, collateralized lending within the business environment. So really a very well diversified pool of opportunities, including jewelry finance, art finance. So things that people generally may not be aware exist, but opportunities that have come to the fore due to the fact that following the financial crisis of 2008, banks were really forced out of a lot of these sectors. And therefore, you've got people who are looking at generating economic value. And if they have an opportunity to make money, they're willing to pay substantially higher rates of return in order to attract capital to finance those opportunities.
So Don, as you described, bond yields are crazy low right now. And so all these specialty finance companies are growing and there's lots of capital chasing income. So paint a picture for me. What does specialty finance look like in 5 to 10 years? What does our economy look like? How's it going to change given that there is a lot of money chasing returns and banks are not the best provider of financing for all these segments. So what does the world look like in the US in 5 to 10 years based on what you're seeing, based on the specific companies you're tracking and how you see them developing and building out their infrastructure? What do you see in the future?
As long as the Fed remains easy, and that doesn't mean they have to keep rates at essentially zero. They can raise rates somewhat, but as long as the Fed has a large balance sheet, as long as the Fed is in general accommodative, there is an enormous amount of capital chasing a relatively small number of opportunities. Most investors really only have equities available to them. And if you listen to CNBC on any given day, you'll hear somebody say, well, I'd rather invest in a consumer staple equity that's paying me a solid dividend rather than buying bonds, right? So as long as that capital's there, there's going to be more astute capital that's looking for opportunities outside of the publicly traded opportunities. Now, we've seen any number of business models emerge that circumvent traditional business models, right? Whether you're talking about Uber or Amazon or Robinhood, you've got all these fintech models that come out and facilitate the deployment of capital to areas where somebody's trying to create a new business model. Certainly that's happening in structured finance. So I think what we'll see is increasing technical innovation within the market, more and more marketplaces that allow investors entry to these markets, and therefore more product that's created to fill the demand that exists because of easy monetary policy. And so I think both the technological model as well as the fiscal and monetary environment will propel that. But the business environment really benefits from the availability of capital to these segments that used to be served by banks that are no longer. So I think that the good ones, yields will come down in time because they'll command the majority of the capital, and there's only so much capital they can deploy. And there'll always be ones out there that offer higher yields and more risk. But right now, we're really living in a sweet spot where you can get these higher yielding opportunities with less risk because the market has not fully developed yet. So my expectation would be the market will develop as long as the liquidity remains in place.
Wonderful. Don, it's been a pleasure. Really appreciate you doing this.
Nope. My pleasure, and I wish you great success with the series.
I'm Jan Brzeski, and you've been listening to Beyond Wall Street.